insurance could very well be, I don't know, 30–40% of the value of the car business, frankly. And as we've talked about before, with a much better feedback loop, instead of it being statistical, it can be specific. Now, obviously, somebody does not have to choose our insurance, but I think a lot of people will. It's going to cost less and be better, so why wouldn't you?
So what is Tesla insurance, and what does Elon know that leads him to believe that it could be 30 to 40% of the value of the car business? Let's find out. So let's first start with a quick rundown of the insurance business. Insurance is basically you collect premium from a lot of different people, pay out some claims to a subset of those people, and if done right, the premiums will be greater than the payouts by the end of the year. So the first question is, how much should you collect each year from everybody? Well, that depends on how likely you are to pay a claim. For car insurance companies previously, that was done by collecting lots of data such as your driving record, how much you drive, your location, i.e. do you live in a nice neighborhood or somewhere with lots of break-ins, your age, your gender, the car you drive, your credit, and the amount of insurance you have. Essentially, all these factors combine to provide an estimate for how likely you are to get in a crash each year. So what's missing from that list? Well, lots of really relevant information actually, like what time of day you drive. Do you drive at night when no one else is on the road, or during the day during rush hour? Do you tailgate when you drive? Do you not tailgate? Do you use your turn signal when you change lanes? Are you an aggressive driver? And so on and so on and so on. So much information could be useful to determine just how likely you as an individual driver are to get in an accident. This information would help the insurance actuary provide the cheapest rates to the best drivers and the not so cheap rates to the not so good drivers. Fortunately for Tesla, they have all this information. So while this is definitely a disproportional information advantage that Tesla has, there are 3 other main factors they're focusing on to help drive down the cost of the Tesla insurance and make it also more profitable for the company. These 3 drivers to lower costs are 1, lowering the repair costs by using the Tesla Service Center, 2, adding an autopilot discount, and 3, lowering commissions normally taken by other insurance companies. Let's review these points to better understand how this will help Tesla's competitive advantage. For my research, it sounds like Teslas are pretty expensive to repair, especially at non-Tesla service centers. So, by expanding the Tesla Service Center repair capabilities, they'll be able to drive down the cost to repair their vehicles. And in fact, Tesla in January of 2021 announced in a press release that collision repair is here. Fix minor dents, scuffs, scratches, and more now at your local Tesla service center as an alternative option to a body shop. In addition to the service centers, Tesla also has 10 body repair shops around the country. Although 3 of them are in California, 2 are in Maryland, and the other 5 are scattered around the rest of the country. In addition, Tesla first announced these body shops in the fall of 2018 with 9 of these body repair shops, and there's only 10 right now, so they aren't really expanding very quickly. And in fact, they've closed down about a third of those and replaced them with another third in different parts of the country. However, as they get more cars on the road, these will ultimately become more beneficial and more profitable, maybe run less of a loss. I don't know the financials behind these businesses right now, but it should make them more viable going forward. Next is the autopilot discount, and this one's pretty straightforward. If you drive an autopilot, you're less likely to get in a crash. How less likely, you ask? Well, that's a great question. The TSLA estimates that there's a crash about every 500,000 miles in the US. Tesla does fortunately publish crash data, and without autopilot engaged, there's about 2.4 million miles per accident, and with autopilot engaged, it's at about 4.59 million miles per accident. You should also take these figures with a little bit of a grain of salt, since the autopilot is normally driven on the freeway, which is a little bit easier than the complex interconnections of roads with stop signs and stop lights and pedestrians, etc., etc. So these 4.59 million miles are of the easier driving variety. However, this will change once the full self-driving beta is rolled out to more and more people. This will help provide a better mix of not only highway, but then city and local miles. Now finally, let's get into lowering commission costs. From my research, I found that about 5 to 15% of the insurance premiums actually go to the salesperson. Now Tesla can actually save pretty well in this area because every Tesla owner has the Tesla app, and from the Tesla app, it's pretty simple to request a quote from the Tesla insurance straight from the app. With Tesla's eliminated commission structure plus reduced advertising budget, and I think we've all seen car insurance advertisements on TV all the time, and Tesla won't really need to do this since you can request a quote straight through the app. All these things combined should help them have a better cost structure than basically every other car insurance company on the road. So now that we know how Tesla plans to achieve industry-leading pricing, what's it all worth for the company? ARK Invest estimates that the revenue generated from the Tesla insurance by 2025 will be $23 billion in their bear case and $6 billion in their bull case. This is because ARK assumes that the autonomous driving is up and running and will generate them an astonishing $327 billion in that year. So I think it's a pretty fair trade-off from the $23 billion of revenue from the insurance down to just 6. All right, so for the cost of the insurance, we're going to use the Value Penguin, which has the average cost of insurance for vehicles in this graph. We'll use the Model 3 for calculations as it's the most common vehicle at the moment. Based on the table here, we can see that Tesla insurance isn't actually cheaper than a few other companies. This is partially because they are actually still using the same information that others do, i.e. what kind of car you drive, where you are, how much you drive, etc., etc., that same list I mentioned earlier. However, once they turn on the data-driven algorithms, I would expect there would be a reduction in price for the good drivers and an increase in price for the bad drivers. Now, this actually might drive some Tesla owners to the other insurance companies because the rate they were given by Tesla is higher than what they were hoping to pay. And for the other insurance companies, actually might be skeptical of any Tesla owner that's coming to them for insurance because if Tesla won't insure them and if Tesla knows how they drive, maybe they're not really a good insurance risk. Okay, so that was a little bit of a tangent. So let's get back to the calculation here. So if we use the low end of the estimate and use the 2360 as our base estimate for what Tesla needs to beat, that would mean if they're 30% lower than that estimate, their insurance would cost on average per year $1,652. Now if we assume that by 2025 Tesla has 15 million vehicles on the road and every single one of them has Tesla insurance, that would be about $25 billion of revenue. Now keep in mind, not every single car on the road is going to have Tesla insurance by 2025. Even if Tesla was 30% cheaper than other insurance companies in the US, they're still selling cars in China and Europe and all over the world. And having insurance for all these cars all over the world is going to take a lot of time and a lot of money. And Tesla might not set up their own insurance in every single country where they sell vehicles. All that is to say, they're not going to insure all 15 million vehicles on the road by 2025. And as a second point to that too, the 15 million vehicles by 2025 I assumed are based on a rough estimate of the ARK Invest bear case, and this is even substantially over other people's estimates, which have only about 2 million vehicles delivered in 2025, whereas ARK, in my estimate, uses 5 million vehicles in 2025. All right, so for calculation purposes, we'll assume that 50% of Tesla vehicles are insured by Tesla Insurance in 2025. That's probably on the high end, but it's a good starting point. That would mean they would collect about $12.4 billion in insurance premium every year. Other insurance companies have an operating margin of about 15 to 20%. So for Tesla, we're going to give them the benefit of the doubt and put them at the high end at 20% for our calculations. That would mean about $2.5 billion a year of gross profit for Tesla. So that's still quite a bit lower than the value of the vehicle business if they're selling 5 million vehicles a year. So why does Elon think it could be 30 to 40% the value of the vehicle business? Well, let's keep going. I believe he's looking at the overall value of the insurance business on a per vehicle basis relative to the vehicles themselves, not just on a yearly basis. So if we take a look at Tesla's 10K, we can see that Tesla earns a gross profit excluding credits of about 21%. So if they sell a $50,000 vehicle, Tesla would expect to make about $10,500 of gross profit, and 30% of the $10,500 is $3,150. So if we again go back up to our estimated insurance premium of $1,652 and take the 20% estimated profit from that, that would give us $330 per year of profit per vehicle insured. Okay, so now we know that about 30% of the value of the vehicle is about $3,100, and the Tesla insurance every year should earn on a vehicle insured about $330. That means that every insured vehicle, if it's insured for 10 years, would be about the value of what a $50,000 vehicle would be to Tesla itself. So how long should your Tesla last? Well, about 300 to 500,000 miles. So if we assume that the average driver drives 15,000 miles per year, that would mean on the low end, the vehicle should last 20 years, and on the high end, about 33 years. So again, go back to my initial estimate of 50% of vehicles are insured by Tesla. That would mean if you insure 50% of the vehicles over 20 years each at the $330 per vehicle, that gets you to basically spot on 30% the value of each $50,000 vehicle sold. So what are the takeaways here? Well, I used quite a few assumptions in this calculation. I'll leave them in the description below. Feel free to tweak them as much as you want and come up with your own estimates for what the Tesla insurance is worth. The major caveat here is if they're able to roll this out across the entire US, all of Europe, and all of China, where most of the vehicles are currently sold. And as of right now, Tesla insurance is only available in California and has been since 2019, and it's not rolled out to any other state just yet, although later this year is expected to roll out in quite a few more states. That's all I have for you guys this week. If you think I missed anything or want to add to the conversation, please leave a comment down below. If you enjoyed, please give a like, and don't forget to subscribe for more content. I'll see y'all next time.